Something unusual is happening in the silver market right now, and you can feel it in the way people are talking. The tone has shifted. The calm discussions about long-term value have been replaced with nervous questions. The confident voices that once said hold forever are now whispering something very different. And the question floating everywhere is simple but extremely dangerous if answered too quickly. Should you be exiting silver right now? Before you even think about answering that question, there is something important you need to understand. Markets rarely move in a straight line, and they almost never reward emotional reactions. When prices start swinging, when headlines become dramatic, when conflict appears on the front page of every news outlet, the human brain goes into survival mode. People stop thinking strategically and start reacting instinctively. And instinct, when money is involved, is often the fastest way to lose it. Right now, the noise surrounding silver is louder than it has been in a long time. Some voices are screaming that a massive collapse is coming. Others are insisting that silver is about to explode to levels nobody imagined possible. And caught in the middle of those two extremes are ordinary investors trying to figure out what is real and what is manipulation. The truth is that most of the panic you are hearing has very little to do with the actual fundamentals of silver. Instead, it is the result of something much more powerful: uncertainty. Uncertainty about global conflict. Uncertainty about energy markets. Uncertainty about inflation. Uncertainty about currencies. And uncertainty about whether the financial system itself is becoming more fragile than people want to admit. Whenever uncertainty reaches a certain level, markets begin to behave strangely. Assets that are supposed to act as safe havens sometimes fall. Assets that appear risky sometimes surge. Prices disconnect from narratives, expectations break down, and the result is confusion. That confusion is exactly where bad decisions are born. To understand what is really happening, you have to step back from the daily price movements and look at the bigger environment. Because silver does not exist in isolation. It sits at the intersection of multiple powerful forces: industrial demand, monetary psychology, geopolitics, energy markets, currency stability, and investor sentiment. When those forces move in different directions at the same time, the result is volatility. And volatility creates fear. Right now, that fear is being amplified by headlines related to global conflict. Whenever a conflict escalates, financial markets immediately begin to speculate about the consequences. Will energy supplies be disrupted? Will shipping routes become dangerous? Will governments impose sanctions or trade restrictions? Will inflation surge again? These questions begin circulating almost instantly, and investors start repositioning their portfolios before the answers are even known. But here is the problem. Headlines move faster than reality. A threat is not the same as an action. A rumor is not the same as a confirmed event, and a temporary disruption is not the same as a permanent shift. Markets, however, do not wait for clarity. They react immediately. Traders sell assets to reduce risk. Funds raise cash to protect themselves from potential losses. Positions that were built during calmer periods suddenly become uncomfortable to hold. When that process begins, liquidity becomes the most important factor in the market. Liquidity simply means how quickly an asset can be converted into cash. And when investors are desperate for liquidity, they do not always sell the worst asset in their portfolio. They sell the asset that is easiest to sell. That is why even traditionally defensive assets can fall during moments of panic. Silver is particularly sensitive to this dynamic because of its unique nature. Unlike some other precious metals, silver sits in two worlds simultaneously. It is both a monetary metal and an industrial metal. It is owned by long-term investors who view it as a store of value, but it is also traded aggressively by short-term speculators who treat it like a commodity. This dual identity creates a situation where silver can move violently in either direction depending on which group is dominating the market at a given moment. If speculative traders are in control, silver can rise rapidly as momentum builds. If those same traders suddenly decide to exit their positions, silver can drop just as quickly. For someone watching the price chart every hour, this behavior can feel terrifying. But the reality is that short-term volatility does not necessarily mean the underlying thesis is broken. One of the most common mistakes investors make is confusing a stressful moment with a permanent change. A few difficult days in the market can convince people that everything they believed about an asset was wrong. They begin questioning their strategy, second-guessing their decisions, and wondering if they should abandon their position entirely. This psychological pressure becomes even stronger when outside voices start offering simple solutions. Someone says the system is collapsing tomorrow. Someone else claims the metals market is manipulated and doomed. Another voice insists that productive assets are the only rational investment. Suddenly, the investor who once felt confident begins feeling overwhelmed. The mind starts searching for certainty, and certainty is exactly what aggressive marketers love to sell. Whenever fear spreads through financial markets, a predictable ecosystem emerges. Some people sell disaster narratives. Others sell miracle opportunities. Both groups thrive on emotional reactions. In the precious metal space, this dynamic is especially powerful. There are companies whose entire business model revolves around convincing people to move large amounts of money into physical metals products. They advertise protection from inflation, protection from currency collapse, protection from geopolitical instability. Some of those concerns are legitimate, but the way they are presented often creates a sense of urgency that pushes people into decisions they have not fully thought through. When urgency is combined with complex pricing structures, investors can end up paying far more than they realize. Many people believe they are buying silver at the market price. In reality, they are buying silver at the market price plus a premium, plus a spread, plus potential storage costs, plus additional fees depending on the product they choose. By the time all of those layers are added together, the investor may start their position already at a disadvantage. That does not mean silver itself is flawed. It simply means the marketplace surrounding silver is full of incentives that investors need to understand. Incentives shape behavior. If someone earns a commission when you purchase a product, they have a strong motivation to encourage that purchase. The more urgency they create, the faster the decision is made. The faster the decision is made, the less time you have to analyze whether the transaction actually benefits you. Understanding this incentive structure does not require cynicism. It simply requires awareness. Because once you recognize how financial incentives operate, you can filter the information you receive more intelligently. And when you do that, the conversation about silver becomes much more balanced. Silver is not a magical asset that automatically protects you from every financial risk. But it is also not a useless relic with no role in modern portfolios. It is simply a tool. And like any tool, its usefulness depends entirely on how it is used. Some investors hold silver as a hedge against extreme financial scenarios. They are not expecting it to produce steady returns like a business. They are holding it as insurance. Insurance is rarely exciting. It does not generate income. It does not compound in the same way productive assets do. But it provides protection during specific types of stress. Other investors approach silver as a trading asset. They attempt to profit from price movements by entering and exiting positions based on technical signals, macroeconomic trends, or market momentum. Both approaches can exist simultaneously. Problems arise when investors confuse the two. Someone who intends to hold silver as long-term insurance should not panic every time the price declines for a few weeks. And someone who intends to trade silver actively should not pretend that they are simply stacking a long-term store of value. Clarity about purpose is essential. Without that clarity, every price movement feels like a crisis. Another factor influencing the current debate is the extraordinary level of valuations across multiple asset classes. Major stock indexes are sitting at levels that once seemed unimaginable. Real estate prices in many regions remain elevated. Even traditional safe assets are trading in unusual ranges. When markets reach these kinds of extremes, investors begin searching for anchors. They look for something that feels stable. Some people choose cash. Others choose bonds. Some focus on productive businesses. And others turn toward precious metals. This search for stability is not irrational. It is a natural response to an environment where traditional signals appear distorted. But once again, the key issue is balance. Concentrating too heavily in any single asset can create vulnerability. Even assets with strong long-term narratives can experience long periods of stagnation or decline. History is full of examples where investors became so convinced about a particular thesis that they ignored the possibility of alternative outcomes. When reality eventually diverged from their expectations, the financial consequences were severe. The purpose of a resilient portfolio is not to predict the future perfectly, it is to survive multiple possible futures. That means maintaining a mixture of assets with different characteristics. Some assets provide growth, some provide liquidity, some provide stability, and some provide protection against rare but extreme scenarios. Silver fits into that final category for many investors, but that role does not require blind devotion. It requires rational sizing. The portion of a portfolio allocated to precious metals should reflect the investor's goals, risk tolerance, and time horizon. For someone deeply concerned about currency stability, the allocation might be larger. For someone focused primarily on income generation, the allocation might be smaller. There is no universal formula. What matters is that the decision is intentional rather than emotional. When decisions are intentional, temporary volatility becomes easier to tolerate. But when decisions are driven by fear, every headline feels like a threat. And that brings us back to the central question that triggered this entire discussion. Should you be exiting silver right now? The answer cannot come from a headline. It cannot come from a commentator. And it certainly cannot come from a salesperson. It can only come from your own plan. If silver was never part of a clearly defined strategy, then perhaps this moment of uncertainty is an opportunity to rethink your approach. But if silver was included deliberately as part of a broader portfolio structure, then a few turbulent days should not automatically trigger an exit. Because the most dangerous habit in investing is reacting impulsively to short-term noise. Markets are constantly testing your emotional discipline. Every spike invites greed. Every drop invites fear. And the people who survive long enough to benefit from long-term trends are usually the ones who resist both impulses. Right now, the silver market is simply reflecting a world that feels unstable. Conflict, inflation, currency uncertainty, and shifting geopolitical alliances are all feeding into a climate of unpredictability. That unpredictability is uncomfortable. But discomfort alone is not a signal to abandon a strategy. Sometimes it is simply the price of participating in financial markets. And understanding that difference is what separates reaction from strategy. There is another layer to this entire discussion that most people completely overlook, and it may actually be the most important one. Markets are not just places where assets are bought and sold. Markets are places where beliefs collide. Every investor enters the market with a story in their head. Some believe technological innovation will drive the next era of prosperity. Others believe the financial system is approaching a breaking point. Some trust central institutions to maintain stability. Others see those same institutions as the source of future crises. Silver sits directly in the middle of these competing narratives. For some people, silver represents insurance against systemic failure. It is a physical asset that cannot be printed, cannot be digitally erased, and cannot be diluted through monetary policy. That physical nature gives it psychological power. But for other investors, silver represents something entirely different. To them, it is a volatile commodity that does not generate income and does not participate directly in economic growth. Two completely different interpretations of the same asset. And when two opposing narratives compete in the same market, the result is turbulence. Right now, that turbulence is being intensified by geopolitical uncertainty. Whenever global tensions increase, the entire financial system becomes more sensitive to shocks. Energy markets react first. Then currencies begin shifting. Bond yields move, equity markets respond, and eventually precious metals are pulled into the storm. But the path metals take during those moments is rarely straightforward. Sometimes metals surge because investors seek safety. Sometimes they fall because investors need liquidity. Sometimes they do both within the same week. This confusing behavior can make investors feel like the rules have changed. But the rules have not changed. What has changed is the level of stress within the system. When stress rises, market participants begin prioritizing survival over optimization. Large funds reduce leverage. Institutions increase cash reserves. Traders close positions to manage risk exposure. And when that happens, price movements stop reflecting pure fundamentals. They reflect positioning. Positioning is a powerful force that many individual investors underestimate. When too many traders are positioned in the same direction, even a small disturbance can trigger a cascade of liquidations. Prices move quickly, not because the underlying asset suddenly lost value, but because too many participants were leaning the same way. Silver has experienced this phenomenon many times throughout history. Sharp rallies fueled by enthusiasm are often followed by equally sharp corrections fueled by forced selling. The underlying demand for the metal may remain unchanged, but the financial structure surrounding the market shifts. Understanding this dynamic requires patience. It requires accepting that the market's short-term behavior may appear irrational even when the long-term fundamentals remain intact. This is where many investors struggle. The human mind naturally seeks patterns and explanations. When prices fall unexpectedly, people assume something must be fundamentally wrong. They begin searching for narratives that explain the drop. Some conclude that the asset was overhyped. Others conclude that powerful institutions manipulated the market. Still others conclude that the entire thesis was flawed from the beginning. But sometimes the explanation is much simpler. Markets fluctuate because people fluctuate. Fear and greed constantly push capital in different directions. That psychological cycle has existed for centuries, and it will continue long after today's headlines disappear. Another important element in the current silver debate is the role of productive assets versus stores of value. There is a powerful argument that productive assets, such as businesses that generate earnings, will outperform inert assets over long periods of time. Businesses can expand, innovate, reinvest profits, and distribute dividends. Those processes create compounding growth. Silver, by contrast, does not generate income. It does not produce cash flow. It does not innovate or expand. It simply exists. This characteristic leads some investors to dismiss precious metals entirely. They argue that capital should always be allocated toward productive enterprises. But that argument, while logical, ignores an important reality. Productive systems operate within financial systems. If the financial system itself becomes unstable, the performance of productive assets can be disrupted. History contains multiple examples of economic systems experiencing currency crises, banking collapses, or inflationary shocks. During those periods, traditional financial assets often struggle to maintain their purchasing power. Physical stores of value can sometimes provide a form of stability when monetary systems are under stress. That does not mean they outperform every other asset, but it explains why they continue to exist within modern portfolios. The debate between productive assets and stores of value is not a battle with a single winner. It is a balancing act. A resilient financial strategy recognizes the strengths and weaknesses of both categories. Businesses provide growth and income. Hard assets provide protection against extreme scenarios. Combining those characteristics can create a portfolio that survives multiple economic environments. However, the moment investors start treating any asset as a guaranteed solution, trouble begins. Guarantees do not exist in financial markets. Even the most convincing narrative can fail when conditions change. This is why disciplined investors spend more time thinking about risk management than about prediction. Prediction feels exciting. Risk management feels boring. But risk management is what keeps investors alive when predictions turn out to be wrong. Consider what happens when someone allocates an enormous portion of their wealth into a single asset based on a compelling story. If the story unfolds exactly as expected, the results may be extraordinary. But if the story develops differently than anticipated, the consequences can be devastating. This asymmetric risk is why diversification remains one of the most powerful tools available to investors. Diversification does not eliminate volatility, but it prevents any single mistake from becoming catastrophic. For someone holding silver today, the key question is not whether the metal will rise or fall next week. The key question is how that position fits within the broader structure of their financial life. If the allocation is modest and intentional, short-term volatility may simply be part of the journey. But if the allocation is so large that every price movement causes emotional distress, the position may be improperly sized. Proper sizing transforms volatility from a threat into a manageable inconvenience. Improper sizing turns volatility into panic. Another subject that deserves careful attention is the growing popularity of financial products promising yields on precious metals. These structures often advertise the ability to earn a return on metals without selling them. The concept sounds appealing. Instead of paying storage costs while holding a metal that produces no income, investors are offered the opportunity to receive a small yield. But every yield has a source. Yield does not appear out of thin air. When someone receives a return on an asset, another party is using that asset for a purpose. Understanding that purpose is essential. Is the metal being lent to institutions for trading activities? Is it being used in derivative structures? Is it part of a complex financing arrangement? Each possibility introduces different forms of risk. Counterparty risk, liquidity risk, contract risk. Those risks may be acceptable to some investors, but they should never be ignored simply because the marketing language sounds attractive. Financial history contains countless examples where seemingly small yields mask significant risks. Whenever yield is involved, transparency becomes critical. An investor should understand who holds the asset, who controls it, and what happens if market conditions deteriorate. Asking these questions does not indicate paranoia. It indicates responsibility. Another pattern visible in today's financial media is the stacking of promotional incentives alongside urgent narratives. Content may begin with alarming headlines about economic instability. Then it transitions into discussions about investment opportunities. After that, it introduces giveaways, sponsorships, subscription offers, and limited-time promotions. Individually, each of these elements may appear harmless, but when combined, they create psychological pressure. Urgency triggers fear, promotions trigger excitement. Together, they encourage rapid decision-making. Rapid decisions are rarely optimal decisions. A disciplined investor learns to slow down when others are speeding up. If a message creates the feeling that action must occur immediately, that feeling itself becomes a signal to pause. Time is a powerful analytical tool. When you step away from the emotional intensity of the moment, clarity often emerges. You begin examining your own financial position instead of reacting to someone else's narrative. You evaluate your liquidity needs. You consider your investment horizon. You review your existing asset allocation. Only after that process should you consider whether any adjustment is necessary. For someone holding silver today, a simple mental exercise can reveal a great deal. Imagine the price of silver declines significantly next week. Would that decline force you to sell? If the answer is yes, then the position is too large. Now imagine the price of silver rises dramatically next week. Would you feel overwhelming regret for not owning more? That reaction is common, but it should not dictate strategy. A well-designed plan should feel acceptable in both scenarios. Not perfect, but acceptable. That emotional neutrality is a sign that the allocation is balanced. If every possible outcome feels stressful, the structure of the portfolio may need adjustment. At its core, investing is not about finding the perfect asset. It is about constructing a system that allows you to remain rational under pressure. Because pressure is inevitable. Markets will experience crises. Geopolitical events will disrupt expectations. Economic cycles will produce booms and contractions. The only certainty is that uncertainty will continue. In that environment, the most valuable skill an investor can develop is the ability to think independently. Independent thinking does not mean ignoring outside information. It means evaluating information critically. It means asking questions about incentives. It means separating evidence from speculation. And it means recognizing that the loudest voices are not always the most accurate ones. Right now, the silver market is surrounded by narratives. Some claim the metal is on the verge of a historic breakout. Others insist the rally is unsustainable. Both positions may contain elements of truth, but neither narrative should replace personal analysis. Because the real question is not whether silver will move. All assets move. The real question is whether your strategy can survive those movements. If it can, temporary turbulence becomes manageable. If it cannot, even small fluctuations can become overwhelming. And that realization brings us back to the central issue that started this entire discussion. Should you be exiting silver right now? The answer depends entirely on why you owned it in the first place. If silver was purchased impulsively without a clear purpose, reassessing that decision may be wise. But if it was acquired as part of a deliberate strategy designed to navigate uncertain economic environments, abandoning it during a moment of uncertainty may defeat the original purpose. Markets constantly attempt to push investors toward extreme reactions, either panic selling or euphoric buying. The discipline to resist both extremes is rare, but it is also the quality that most consistently separates successful investors from unsuccessful ones. Because in the end, financial markets are not a contest of intelligence. They are a contest of patience. And patience is often the most valuable asset of all. And when you step back and look at everything happening right now, the volatility, the headlines, the fear, the excitement, you start to realize something important. Markets will always be noisy. There will always be someone telling you to panic and someone else telling you to go all in. But the truth is that wealth is rarely built in moments of panic or hype. It is built through patience, discipline, and clarity about why you own what you own. Silver itself hasn't suddenly changed its nature in the last few days. What has changed is the emotional temperature of the market. And when emotions run hot, the worst decisions often follow. So before you rush to exit, before you chase the next narrative, pause and return to your plan. Because in the end, the investors who survive turbulent periods are not the ones who react the fastest. They are the ones who remain calm enough to think while everyone else is reacting. And in a world filled with uncertainty, that calm discipline may be the most valuable asset you can hold.